Hello and welcome to the latest edition of Citrus Insights. I'm joined today by a fantastic guest, and what a great time to have Jonathan join us. So it's Jonathan Raymond, investment manager from Quilter Cheviot today. Jonathan, thank you so much for finding the time to join me.
Thanks, Richard. Good to be here as always.
So for those of you that haven't maybe met or seen Jonathan before, Jonathan is an investment manager responsible for constructing and managing portfolios for a broad range of clients and their advisors. He joined Quilter Cheviot back in 2013, following roles at a large private bank and a startup wealth management firm. So nearly 20 years of investment experience now. Jonathan sits on both the asset allocation and investment funds committees, contributing to the development of the firm's investment strategy. Jonathan holds a master's degree in economics and graduated with first-class honours in economics from the University of Exeter. He became a chartered financial analyst in 2011 and is a chartered member of the Chartered Institute for Securities and Investment. Married with two young children, Jonathan comes from a Welsh farming family and regularly returns to the farm. And outside of work, he enjoys rugby and golf and maintains a keen interest in economics, politics, and current affairs. So, really timely, Jonathan. Thank you so much. I guess, we're seeing some volatility at the moment, lots going on in the news. And where I'd like to start is, I think when things like this happen, there's kind of these standard pictures that roll out across TV and media of, traders and investment managers buying and selling and phones going and absolute chaos. Are you frantically trying to change, investments at present, like the media would report? Or actually, is it relatively calm for you? And if so, how are you navigating the current volatility in the markets?
Yeah, great question, Richard. I mean, I would say if you sort of look over my right shoulder, you can't see anyone, frantically running down the corridor, shouting down the phone and going, buy this, sell that, buy this, sell that. So I can assure you things are pretty calm and calm here at the moment, albeit it's the end of the tax year coming up. So there's quite a lot, quite a lot happening day to day. But no, certainly, I think lesson number one when it comes to portfolio construction is eggs and baskets and make sure that the roof is fixed when the sun is shining. So we always want to be coming into, so-called crises, in inverted commas, when, with portfolios in good shape and having sufficient diversifying assets within them to kind of weather as all storms as well as possible. And really that's the sort of fundamental foundation, building block, cornerstone, if you like, of portfolios, is to make sure that we've got things in them that when rainy days come along, that they are able to withstand whatever's being thrown at them, and therefore we don't have to be panicked into making kind of rash decisions and getting out of certain things or buying certain things on the way up. So it's very calm and measured here at the moment, Richard. Portfolios are of course not immune from what's been going on in terms of stock market weakness and things over the last few weeks, but we're bearing up okay. We're bearing up okay.
Good. And it's really nice to hear that. I can't help but think of the kind of the analogy is that the aircraft, isn't it? And you're going through turbulence, and you always have this image that the pilot's there and first officer, etc., and they're navigating and they're going up and down and moving, and then you speak to them afterwards, they go, no, most of that was autopilot. And you're like,
Yeah,
right,
yeah.
okay. And in some ways it's like this. I'm getting the sense of a lot of calm. You've done a lot of work beforehand. You kind of have put things where you need to put them, so to speak, and therefore you're nicely calm in front of us today. So that's really good to hear. Thank you. And obviously really reassuring for people as well.
Yeah. Yeah, no, definitely. It's a good analogy of that with the captain and the aircraft. I think that's exactly how it is. You've been here before, you've done the drill, you've got your procedures in place. There's no need to panic. There's no need to make any rash changes. And actually, if you do want to make some changes, you can make them from the position of strength. So, if there are stocks and companies you like or funds you want to buy or cash that you might want to invest, then actually a few bad days does give some opportunities to do that, to kind of lean into some of the bad news.
And that's a good point. And you were talking about the different crises that we'd had, and I was thinking back to go, well, maybe surely we have been here before. From a Middle East perspective, it feels like, quite a few both large scale and regional wars within the Middle East over the last kind of 60 years, causing a variety of market shocks. And then you think back to more recently and go, kind of, we had the Ukraine war, we had tariffs, and obviously the beginning of that kind of day last April, COVID, financial crisis. You wheel all these things out, and every time we come to one, and it's absolutely not to play anything down at all, But clearly, every time we come to one, it feels like the biggest crisis we're facing, and it's
Yeah.
really hard to imagine a way through it. Are we in the same position, or is this really any different to maybe what we've experienced before?
Think they're all different and they're all the same in different ways. There are the types of shocks that you referred to there, and it has been quite a difficult 5, 6 years for investors since the pandemic. We've had a few decent setbacks and kind of so-called crises along the way. Yet, ultimately, if clients had remained investing over the last 6.5 years, and it's pretty much the sixth anniversary of the depths of the pandemic sell-off now, outcomes would have been very good in total return terms for those who had stayed the course, but you would have had to have put up with a lot of volatility along the way. So it's not been an easy time for investors, but it has been ultimately a lucrative one for those who have maintained discipline, which I think is a word we tend to use quite a lot, and have stayed the course and have not been reacting to events and news and making rash decisions. So, yeah, I mean, these crises do happen. They're all slightly different. They're all slightly the same. I think at the moment we're probably in a crisis that's most similar to the outbreak of the Russia-Ukraine war in terms of supply side issues, energy, potentially food price inflation as well, with fertilizer and things supposedly coming out of the Persian Gulf, and obviously natural gas in the UK and Europe is an issue. So that's the most obvious parallel for the time being, but the potential consequence and impact of what we've seen so far is not as great as it was in 2022, albeit things could get worse and things could continue for another few weeks and months, and all of a sudden we would be staring at a fairly big impact.
Okay. And I guess it leads us nicely to kind of the impact of the oil price. I think Brent crude's gone from sort of mid 60s to over $100 a barrel today, and that's
Mhm.
happened in just the space of 2 or 3 weeks. What's your view of the impact of that scale of increase and now the current level of oil price globally, and of course where it might go?
Yeah, unhelpful, I think, is the short answer. Not yet a catastrophe is the sort of, addendum to that answer. So in the Yom Kippur War in 1974, the oil price effectively quadrupled from $10 to 40, which had a massive impact on Western economies. In those days, the economy was very energy intensive or oil intensive. We used a lot more oil per unit of GDP than we do today. So we've become a lot more efficient in our use of energy, particularly fossil fuels, than we were then. We haven't yet seen the scale of the rise in that scale in the rise of the oil price and gas prices just yet. But that's not to say that if this doesn't continue, then that impact will flow through. I think I sort of consider it as, I said unhelpful in the sense that the Western economies, and in particular the UK, were turning a corner in the sense that inflation was moderating. We'd had the worst of the energy price rises from 22, 23 washed through the system. Interest rates were falling and were set to fall a few more times. We'd had a few kind of budgets behind us, and we were set on a relatively fair course, particularly here in the UK. Consumers were tentative signs that consumer spending was resuming and returning, and savings rates were falling. I think, unfortunately, the psychological impact of just the recent price rise will have put a dent in consumer confidence and will stop that. I'm going to go out and buy a new car and new fridge, freezer, and new TV tomorrow that we might have otherwise seen. But we're not yet at anywhere near the scale of potential impact that we had, the Russia-Ukraine war in particular, in terms of our energy prices and how that impact on inflation. So if I sort of maintain that if this wraps up relatively soon, the next 2 to 3 to 4 weeks, and the oil price does moderate, and I don't necessarily mean come right back down to where it was, but certainly if it gets down into the sort of $80, $75 kind of range, I think that potentially rosy backdrop for particularly Europe and the UK remains and will come through, albeit with a lag. But the longer it goes on, the greater the impact is going to be on inflation, on interest rates, and on the economy in general.
And on that basis, I mean, I was listening to something the other day. Clearly, the government is saying one of the areas it's keeping a very close eye on is to make sure that the market for energy, whether that be heating oil, petrol at the pump, etc., is operating in a way that is, fair for consumers and that no one's trying to take advantage of, the sort of that price hike and understanding, well, where's the visibility behind what the prices are now? They just seem to go up because obviously oil is up. Is it fair or is it more than that? But assuming that that is fair, most of the talk over maybe the last 4 to 6 weeks to 8 weeks even has been about UK base rate reductions continuing through the next few months. Are we now at a point, we've seen a lot of lenders increase the fixed rate mortgage pricing over the last 2 weeks. We've seen a lot of that. Are we now saying that for the next kind of few months, that bank base rate is absolutely not going down? And if anything, there is a risk that it starts to go back up?
I struggle to see an environment, even if the oil prices will remain at $100 for the next 2 to 3 months, where base rates rise this year. I think the economy is in quite a different place to where it was in 2022. Mainly in 2022, we were coming out of the pandemic. We had labour market shortages. We had the reopening. The economy was accelerating and on quite a strong footing. And employees, i.e., people who worked at companies, had strong bargaining power to force through decent wage rises. Whereas today the labour market looks relatively weaker, unemployment is higher, there are more vacancies around, and therefore employees don't have that bargaining power in the same way. So the whole backdrop of the economy does look quite different to how it did in 2022. And many economists argue that a rising oil price is kind of disinflationary in a way, because if your energy bill and your fuel bill's gone up, that actually leaves you less money to spend on other things. And therefore you get disinflation in other areas of the economy, be it eating out, going on holidays, discretionary spending in general. And therefore, if we see a moderate one-time rise in the oil price, even if it's for 2 or 3 months, from say $65 to $100, and it comes back down to 80, central banks in theory should be able to look through that level of inflation as a sort of one-time blip before it reverts to a more normal course, not raise rates. The problem we had in 2022 was you had a commodity price shock across a number of commodities, but you also had a very hot labour market that amplified the impact. Wage growth went up to 5, 6, 7%, and inflation expectations were, in central bank speak, unanchored, which means they went up. And I don't think we have that just yet. Again, if we're still here in 3 months' time or even 6 months' time with $100 oil, and the LNG situation in the UK gets worse and energy bills accelerate, then perhaps that changes a little bit. But for the moment, we think that we can weather this on a sort of one-time price shift. Central banks, particularly the Bank of England, should look through this for now. They may not cut rates as quickly as they may have done, but if we're sat here in September, October, and the oil price has come back down to $80 and inflation is going through its little blip, I would expect the Bank of England to look through that and look to cut rates possibly once for the end of the year still.
Okay. And from a chancellor's perspective, if that doesn't happen, I guess interest rates don't come down, cost of paying back potentially the link to the cost of, UK debt, fiscal headroom commitments for the end of the government, I guess, start to come into risk, and the risk starts to begin the story of, will the chancellor need to come back for more in terms
Yeah.
of tax?
Yeah, and that is the biggest risk. And I think our headroom was a little bit higher at the spring statement than it had been at the autumn budget. So I think there is a little bit of breathing room. From what we've seen so far, it doesn't look like there's going to be a sort of huge energy price guarantee package like we had in 2022 that cost the Exchequer something like 40 or 50 billion. They're talking about much more targeted measures that will be a much more, I guess, cost effective or much lower cost in aggregate. So again, from the Chancellor's perspective, if this all calms down in a month or two's time, I don't think there is a problem. If we're still here in September, October, then possibly the maths and the fiscal headroom has disappeared, and we are facing the sort of the third budget in a row where we're seeing a rising tax burden, which I don't think any of us particularly want to see.
Yeah. Okay. And as an investor, therefore, Jonathan, listening to you today, looking at the news, trying to digest all of this, and trying to remember, to your point, what we've lived over the last one investors lived over the last 6 years. What approach do I take now? What do I do if I'm an investor right now?
Well, I think humans are very flexible and ingenious in the sense that what we've already seen in the Middle East is we're likely to see at least a third to a half of the oil that would ordinarily transit out of the Strait of Hormuz is going to be piped across Saudi Arabia to the Red Sea. So that takes some pressure off. We've got other avenues of opening strategic reserves from governments in particular, which will also release valve. So I think that the first message is remember that human beings are very creative and very good at solving problems. And we are in the midst of doing that. And therefore, as time goes by, we will learn to live and deal with this. And that's the same when we're looking at our portfolios and remembering that what we've got, particularly in our equities allocation, is that we've got companies who are working their hardest to try and mitigate and manage and thrive in any sort of environment. And we've seen that countless times over the last 5 to 10 years. I think purely from an investor's perspective, again, as I mentioned at outset, we should all be ready to go through difficult periods in markets, and that's by being, adequately diversified. We want some bonds, some short-term bonds. We want some cash. We want some exposure to commodity type assets, whether that's through our equities or directly. We want a bit of property, and we want some hedging assets as well if we can, and we want to keep moving around. For those, clearly for those clients who are accumulating wealth and still working and a long time to retirement, these sorts of moments provide opportunities. It just so happens to be the end of the tax year, get that pension and ISA contribution done, lob it in. It's not, it doesn't need to be, too kind of specific or targeted. Just get it invested broadly, get it moving, because, we are seeing, a degree of opportunity. For those where income is more pressing and they're perhaps in retirement, just make sure you're adequately diversified, make sure you've got sufficient cash reserves, make sure you've got, your bond allocation isn't got too much, so-called duration, i.e. the bonds are relatively short dated. Just have a sort of spring clean of your portfolio. We've had a sort of relief rally in the last few days, and that might, if you feel you're too heavily invested, then it might be a good opportunity just to lighten up, because ultimately portfolios have had a really good 12-18 months anyway, so we should be sat on some quite good gains over that period. So stress test your tolerance for risk, stress test your liquidity needs, make sure that your equities and your other assets are kind of well diversified, suitably spread, and obviously go and speak to your localizer who can point you in the right direction if you're struggling for answers.
Great answer for anyone that's listened to that and is kind of not 100% sure. Yeah, speak to your advisor is a great message as well. Jonathan, thank you so much. I have to say, I find your insights absolutely fascinating. I know our viewers do as well. Could spend ages talking, but I think we're timed out for today. But really, really appreciate getting your thoughts over the current situation. So thank you so much for the time today. So that's it for Citrus Insights today. Thank you so much for watching. Take care and bye for now.